everyone. So I'm Jeanette here. I'm the research lead at Crunchbase. I've been at Crunchbase a very long time. I joined when it was back part of TechCrunch. I spent a lot of time working with Crunchbase data, which is never ending. And then in around 2015, I started reporting off of the data, looking at venture trends. And I'm going to be doing a presentation later on. So today we have Ben Narasin from Tenacity Venture Capital, seed investor, and we're going to dive into everything venture and everything seed. I think to kick off, it would be great to find out who's in the audience. Do we have, I know it's small right now, but do we have founders? Great number of founders. Any folks in the venture industry? Same. Family offices? LPs? So some LPs. Okay, so a mix across the event.
So entrepreneurs number one, LPs number two, and one other VC.
Great. Okay.
Oh, well.
Investment banker,
yeah.
there you
Service
go.
provider, right? If anybody is in another area of service, feel free to raise your hand and we can count you.
Yeah.
That could literally be anything. I have, it's like I wish I had learned the term family office when I was retired because, I retired in Incline Village, Nevada, where everybody's retired. I figure it's a small group, so I can rant. And everybody's retired, so nobody cares. Nobody wants to know what you did. All they care about is can you ski. And then I moved here, and yes, exactly.
When did you retire?
I did. My wife says for something like 6 or 8 years, and boy, she didn't enjoy that at all. But I moved here, and when people would say, "What do you do?" I'd say, "I'm retired." My wife's like, "You can't say that." I'm like, "Why not? You look like an asshole." I'm like, "What do you want me to say? I'm between jobs like some unemployed loser?" Hopefully there are no unemployed losers in the audience. And she's like, "Yeah, but people look at me funny." And so what I realized later, I had never heard the term family office, but I could have said, "I run a family office." "Oh, really? How big is it?" "Well, it's about, I don't know, $23 right now. And I'm strongly looking for investments that I can leverage with the $23 I have in my pocket." But it would have been true. I am a family and I have a family office. Anyway, sorry.
So Tenacity Venture Capital. So tell me, well, let's start with Tenacity Venture Capital. What do you do? Where do you focus?
Right. So Tenacity is a seed fund. We tend to lead. We write $1 to $3 million checks. We try to buy enough equity for it to matter because we're a one and done fund. We don't reinvest ever again. So we take pro rata, but we give that to our LPs. So we are sort of, when you have unlimited, we could talk about this if you want. By the way, along the way, we'll at the end leave plenty of time for questions. So think about whether any of this stuff's things you want to drill into more. Traditional venture capital firms will put in $1 and save $3. I put in $4 and save $0 because I want the upside that you get when you go in as early as humanly possible. So that's mainly seed, very occasionally pre-seed, investing in technology of any sort except crypto, security, and med tech. On the crypto side, I'm open-minded to stablecoin because I think that can be used for functional reasons, and crypto is a speculator's game, and speculating is a different type of investing than I'm in. Warren Buffett is a type of investor, buy and hold. I don't think I'm Warren Buffett, but I have a similar approach. George Soros is a different type of investor. He's a speculator. They both make a lot of money, as far as I can tell. But you got to pick.
And so your latest fund, or your first fund, was 60 million. Is that correct? And you raised it 21, 22.
Yes.
Period.
Correct.
And
yep,
then how long did it take for you to sort of invest that fund? How many companies? What's the spread each year?
Got it. So I went out to raise 50, and it went a lot faster than I expected. I did have a 14-year track record to show, which I've been told is top 1%. So I think that helped. Although interestingly, it doesn't help anymore because people are just so whiny about their lack of liquidity, which is interesting to me for a lot of reasons. But I ended up taking 60 instead of 50. I sort of regret that. We talked about this a little bit. It took me 5 years to deploy that capital. That's too long. Everything has a natural cycle. And I think a venture fund, and historically venture funds, typically take about 3 years to deploy. So 5 years is too long. Also, it removed a forcing function that would have been useful to me. I work incredibly hard, and I'm proud of that. It's, the way I grew up, it's the way my dad was. You take these lessons. I don't work hard just for the sake of working hard. But no matter how hard you work, you still need some level of forcing function to get across a line. I'll give you an example. My daughter was an undefeated runner on the peninsula. Now, as soon as she went to something national, she got her butt kicked by people that looked nothing like her and that could do warm-up jumps that cleared her head. But no matter how strong she was as a runner, once she passed the finish line, she's done. right? So you need finish lines in life, something to shoot for, something to give that extra juice. And the reason I bring that up is because I always had plenty of capital. I never had to go out and raise. And it would have been good if I had sort of had more of a tight time frame, normal model for venture, 3-year time frame, about 2.5 years in, you're 70% committed to go out and raise the next fund. I never did that.
So why didn't you have that tight? I mean, most seed funds work on the sort of 3-year, as you say, investing cycle. And we saw in 2021, so just as you were raising, that everyone went out and invested. And I'm doing a presentation later on sort of venture data and Crunchbase, and everyone kind of invested what they should have invested in 2 to 3 years in a single year.
Yeah.
And the industry is still struggling from that. So why, as a seed fund, wasn't there a forcing function for you?
Well, it's just that, so there's a couple of fundamental beliefs I have around venture. One of them is greed for free fees destroys funds. And there's a very famous Alphabet-like fund that is probably one of the worst returners of the last decade, but wow, do they earn fees. And all the GPs will die having never returned money to their investors, but they'll be fat and happy, both literally and metaphorically, from those fees. The other is that you can never lower the bar. When you let fund size or capital availability change your thinking beyond the fact that you can only invest what you have, it's a tragic destroyer of returns. I'll give you 2 examples. So I worked at NEA. NEA was the largest venture firm in the world for pretty much history. It's a little over 30 billion in management, and we were in about a $3.6 billion fund at the time. Before that, I worked at a tiny little fund that had about $150 million and had just raised 300. And in our partner meetings on Monday, both funds had the following conversation. We really need to talk about pace. Interestingly, NEA wanted to talk about slowing down the pace with $3.6 billion. And the $150 million fund wanted to talk about speeding up the pace. Speeding up the pace was so they could get to the fees on the next fund. Not healthy. Slowing down the pace was so they didn't have to do what you just said, which is go back to their LPs after a year and a half and say, hey, we need more money. LPs put in money with a certain set of expectations. And when the last 40 years is that a fund lasts 3 years, and you put in money on those assumptions, and then your GP comes back to you and is like, Art, hey, Art, I really appreciate all that money you gave me. That was awesome. I need more now. But I just gave it to you. Yeah. No, I need it now. I got to go invest in more. And you're like, how do I plan? It's hard to plan when people don't give you sort of consistency.
Yeah. I mean, I think one of the biggest challenges in the venture industry that I see in the data is the absence of liquidity. And obviously 2021 was a very big year for liquidity. I live in Palo Alto, so I'd walk around Palo Alto and everyone would say this was a huge liquidity year. So we haven't seen that since. So we're still living off of 2021 in the venture industry.
Well, 2021 was not just a big year, it was also a destructive year in the sense that people just massively overpaid for things. Most 2021 vintage funds suck. I say that because mine doesn't. Like I don't know the exact numbers because I won't pay anybody for data, including Crunchbase, because I'm literally a solo act. You are looking at the entire team, all 3 of us, me, myself, and I neurotically argue with myself all the time. But little old me is not go out and buy data to tell little old me what I should be thinking and then debate with myself about whether or not that data is useful to me. Anyway, I do respect the value of the data. 2021, people paid a massive amount. So I have 2 data points that make me happy about being a 2021 fund, because it doesn't really matter when I was a fund. It matters how picky I was and what I paid. One is AngelList tells us we're in the top 2% of the 1,250 funds they track. And when Carta published their data on funds, they segmented it by vintage and size. And so for 2021 funds of $25 to $100 million, of which I am, the current top decile IRR is minus 6%. Think about how that sucks. Mine's plus 24. So my attitude is I'm 5 times better than the top decile. But a lot of people paid a lot. And it's funny, I went to an LP once who I met many times like, yeah, but you got all those marks from 2020. I'm like, dude, I started in 20. What, you think people marked up my deals the day I did them? So you asked earlier, and I didn't answer about sort of the timing. I did do 9 deals in 21, 6 deals in 22, 3 deals in 24, 3 deals in, wait, well, it was 9, 6. So in reality, it was a shorter period of time. But the first year I did 9 deals, then I did 6, then I did 3, then I did 3. Last year I only did 1. So it both impacts the forcing function, because you can't, once you start trying, and it's interesting, I am extremely unique That's actually a flawed sentence because unique is a one of a kind, and I hate it when people put qualifiers on unique. I'm extremely distinct, but I might be unique. I don't know. I'm obsessive about trying to understand my own flaws, particularly when it comes to cognitive bias that might impact my investing. And so at the end of last year, as an example, and this is a classic thing I think people do that is a mistake in venture. I had a deal I was working on. I wasn't quite there, but I was pretty excited about it. It's not really relevant, but he is a really cool black founder with this incredible hair, a lot of energy, ex-SpaceX, ex-military, road to rail, just like put him in a box. This is a great guy to put up in the Entrepreneur Museum of Fame if and when he makes it. And there were issues I couldn't get past, not in him. I couldn't get the diligence done because I didn't know anybody in the railroad industry and I was working really hard. So I couldn't make a decision. But it was getting close to the end of the year. And I thought, well, Ben, it'd be really nice if you could finish deploying this fund and then start working on fund 2. And then immediately I screamed at myself, don't be an idiot. It's exactly what kills funds. Shut up and get back to work and make the right decision. Don't make the convenient decision. I'm sure there's plenty of things I've done wrong that I didn't catch myself doing, but that one was fascinating to me because I noticed myself doing it. It's so damn tempting. You wrap it up in a nice bow and that fund is done. And even if it doesn't work out, whatever, it's one of 24 deals. 24 is the answer to your question. Did 24 deals, 20 were seeds, 4 were pre-seeds.
Yeah.
US, UK, and LATAM in the old days, now just the Americas.
So, you said you did one deal last year. So what has changed around seed funding in this sort of AI era? And I hear, what we're seeing in our data is we're seeing seed rounds go up in size. So there's massive seed rounds happening. So seed is also very, very active. When I speak to any venture investor, they're saying we want to invest earlier. We want to find companies earlier. And almost everyone is saying they're trying to invest earlier in the cycle to kind of find those founders that they're going to believe in. So seed has been very active, but at the same time, you did one seed deal. So is that because of you're raising your next fund? Is that just the fund function, or is it that seed has become more?
No, that's the other thing. It's sort of like when I use a lot of allegories and metaphors sometimes because I think it's an easier way for me to communicate a concept that might be complex. Sometimes it's just because I find them enjoyable. So my metaphor for myself is I'm a hunter. Okay, my job is to hunt the rarest of all creatures, the golden dragon. I don't really care about unicorns. So I was a D&D player. Unicorns are merely uncommon. Okay, golden dragons are actually unique. There's like 7 colors of dragons. I'd actually like to have all of them. So net, the more time I spend back in the lodge gathering bullets, the less time I'm spending in the field hunting. To use a violent analogy, I know, but so I've tried to basically, this is a dumb analogy, but who here likes comic books and comic book movies? So there's a character called the Hulk, and he only turns into the Hulk from a normal man when he gets angry. And normally that takes a lot of work. But in the most recent movie, he just turns into the Hulk and jumps out of the plane. And one of the other Avengers turns to him and says, I don't understand. I thought you had to get angry. He's like, yeah, I figured that out. He said, how? Now I'm just always angry. So I'm always fundraising, right? But it's not a primary effort. It doesn't suck up a lot of time. If I meet somebody interesting, I'd rather have LPs that can add value beyond capital. There's a lot of money in the world. And admittedly, it's more of a pain in the butt to get it these days. But still, I've got plenty of money to last me for quite a while. I've got more money to raise if I choose. But I want it from folks that can bring something to the table other than just cash. Because I'm a solo GP, which means I have to use my LP base as my extended partnership. I have to be able to call, like when I was looking for railroad companies, I did find through one of my LPs, a guy named Sahid Ahmadi who runs Plug and Play, that he has contacts in the railroad industry. Great. There you go. That's how I'm going to get that work done. But yeah, it's the nature of seed. A couple of things have changed. One, seed is today what Series A was 10 years ago. There's literally no difference. What I did as seed back then is now called pre-seed. What Series A was back then is now called seed. And we talked about the fact that several funds, I would say Foundation, certainly Menlo to a lesser extent, and even Bessemer, like they just do the same thing they used to do, but it's called seed instead of called Series A. The problem for me is I'm incredibly picky. And every once in a while, I think I should change that. And then I'm taught quickly that I shouldn't, either through experience or through observation. And, in 2 years, I saw 10,000 pitches. I funded 6. Last year, I probably saw 2,000 to 2,500. I funded 1. And it gets sad. Like, use the analogy of a hunter again. Maybe I'm a hunter with a camera. You spend all day looking for that wild beast. and you don't see one for a year, man, does that suck. But the thing is, you can't let that get to you. You can let it get you down, and then you go to work out or something, but you can't let it change your behavior, because then you end up with losers in your portfolio and things go poorly.
So what makes a good seed investment? Because the odds, I mean, if you're a seed founder, those odds sound terrible, like thousands. You're putting in a lot
The
of work.
odds are very bad.
Yeah. And you're having to, so what makes a good seed investment for you?
So I need 5 things to make an investment. People, great idea, huge market. I need to believe there's a future public company worth many billions of dollars. I used to say I need at least $1 billion opportunity. Then I worked for a bigger fund and I was like, that's not good enough. I used to say I need to see billions of dollars of value in opportunity. Then I started to say 5. What I realized we all look for and love, uncapped upside. Where is that future $1 trillion business? Think about the businesses that are currently worth $1 trillion. Take the ones that are there because the land they live on. There's only one of those. That's Saudi Aramco. Yeah. And admittedly, they had to kill a lot of people to own that land. So you could argue that was something they succeeded in. But net, I give them no credit for sticking a straw in the ground and pulling out oil. TSMC, sure, I'll give them credit. But all the rest come from here, right? All venture-backed businesses. Most are actually still based here. Microsoft being the one I can think of that's not, but also funded by a VC in this community. So, venture has the opportunity to invest in the biggest of the big. And that's what we should do. I speak to entrepreneurs a lot. I just came back from a bunch of different places, but one of them was Web Summit in Vancouver. And so I did 2 on stages, and I did 2 sets of office hours, and mentoring, and trying to help entrepreneurs think about how to raise. The thing about venture capital is, it's the quote from the guy that used to rob banks, and someone said, "Why do you rob banks?" And he said, "That's where the money is." People look at VCs and like, well, there's money there, and they invest in companies. Yeah, but very specific types. And this can create a lot of hardship for entrepreneurs, because taking money. So I know for a fact at least once an entrepreneur lied to me. I'm sure it's been more. The reason I know it for a fact is he wrote a book about his experience as an entrepreneur, and he told the story of the journey. And he told the story of how he couldn't get funded, so he just started lying about certain elements of the business. Now, that company ended up selling way too early, and I was not in a position to veto him, nor would I have. But net, he wasn't shooting for the moon. He wasn't shooting for Mars. He was barely shooting for a private jet ticket to New York City. He was like shooting for a seat on Mint on JetBlue. And yet he pitched it as if Mars was the journey. The problem with that is when you raise from real VCs, i.e. tier 1 VCs that sit on your board and have veto power, and they know their job, which is to get to that big outcome, and they believed you, not just because you told them, but because they looked at the data and believed it supported it, and they think there's $1 billion opportunity and you want to sell for 50, the only thing in their mind is, who do I replace this person with to run this company? And so that creates an enormous amount of hardship. And I've seen this happen to people before. Take the flavor of money that matches your goals and ambitions, right? Don't trick somebody into, like, one of the things that infuriates me about Y Combinator are constant game theory BS. It's like, really? So this is a 10-year plus journey. And if you've got an investor that's on your board, wow. People say, I don't know if this is actually accurate, that the average board tenure of a successful company is longer than that of a marriage, right? Because I guess the United States marriages don't even last 10 years, which is sort of surprising. Mine's 30 some odd plus years in. It'd probably be good if I could remember it, but she clearly is okay with the fact that I can't. Anyway, so, yeah, no, she tells me every anniversary her gift to me is not getting mad at me for forgetting. I've had that gift many, many, many times. Now what I do is when I go to fancy conferences or places where sometimes I actually buy things, but usually it's just, goodie bags from Ted or something, I hide those things in a closet. And then I'm like, oh, I didn't forget. I got you this wonderful VR headset. And she's like, you got that at a conference, didn't you? Yes. And I saved it for you. I was at Vancouver, and I got a beautiful glass bottle of bath salts. That's definitely going into the Christmas stocking.
So you were at NEA at one of the big funds, and it seems like in this era, the multi-stage funds are doing very well because they can play at every stage. They can try and go early, but even if they don't make it early, they can keep investing. They're kind of market makers in a way. So having come out of NEA, you were running the seed fund. They stopped the seed fund, although continued investing early, but not necessarily having this standalone seed fund. So what, You know, and I heard Andreessen say recently that there are too many seed funds out there. There are too much investing, that you should leave it to the multi-stage firms, that this needs
You
to
should
be
leave it to, excuse the, we're not being recorded, right? You should leave it to the whores. Oh, I didn't realize. Oh, there are too many girls to date. Just leave it to the professionals. I, as a prostitute, would like you only to come to me for a date. I know that's horrific, but that is the truth of that fund. They hire, sorry, we're not being recorded, so usually I don't get to rant like this. They hire professional consultants and pay them to lie and to tell people that the best place to put your money is in multi-stage funds like Andreessen. Really? Why don't you look at the flipping data? Okay, no returns. They had one good fund, the $320 million fund they had originally. It's a horrific thing. Too many seed funds? Why? Because they want to do the business so they can ignore the entrepreneurs and do absolutely nothing? Ugh. Any quote, oof, oof. I couldn't express more disgust. Now, having said that, they're phenomenal marketers. I envy him for that. Does a great job of marketing. But Mark has done a phenomenal job of making money for Mark. And that's been true since I met him in 1993. And he's never going to change. But are there too many seed funds? Maybe. There were a lot created in 2021. Most of them will die. Probably most of them right now are living out as zombies because they raised. The thing that's interesting about being a VC, look, I have money to deploy. I do try to encourage entrepreneurs to ask certain questions, but I'm not as sort of pedantic as many people are. When you go to a seed fund, how much did you raise? How much do you have now? Are you actively in the market? I raised $12 million. Good to know. How much did you invest? $10 million. How much is in reserves? $6 million. Okay, I don't think that works. And are you in market now? Absolutely. Doing what? Taking meetings. There are people, just like my fake family office thing of I have a family office with 23. There's plenty of people that are VCs. You know what it takes to be a VC these days? Not to actually perform as a VC. The words to come out of your mouth. Because, hey, you could say you were a VC if you invested $50 on AngelList in some little syndicate that you found. But realistically, there are a tiny number of tier one seed funds. There are very few people I consider my contemporaries or that I worry about in a,
And who do you like in the seed fund?
Yeah, you asked me. It's funny because you asked me that yesterday, and I think I came up with two. I still think Mike Maples and Floodgate and Ann and their team. I don't actually know their team. I only know Mike and Ann are doing a great job. I respect what First Round has built, although I think they've gotten into an awkward place as they've started to do their own Series A's, and that really impacts their relationship with venture. In some ways, I'd say folks that were that are now seed, even though it's exactly the same, like Foundation and Menlo, do a good job. I think Greylock has historically done a good job. They've got a relatively new team. I think Sequoia does a good job. Pear is good for pre-seed, although they're probably a little too prolific. Anybody have any ideas for who they think is a good seed fund? I'll tell you. Benchmark doesn't do seed. Benchmark does A. In fact, I took deals to Benchmark. So in the early days, here's the evolution of seed for those of you that haven't spent time obsessing about it. So I started one of the first seed funds in 2007. It was actually the second seed fund ever. Josh Kaufman beat me by 1 week. Still irritates me.
That's really early in the market.
Yes. Yeah. But if I'd worked just a touch harder, I would have been able to say I was the first. Does that mean anything? Does it make me any money? No. But it's still, look, I got an ego. And I like Josh, but man, a press release a week before me, that's just too damn close. Anyway, so we start out. There's two of us. Maybe some other people come along. Jeff Clavier claims he was there. I never saw him. I think he was an angel. And
he was around early. Were you in the Valley or were you in New York?
Yeah,
you were
I
in the Valley.
I was here.
Yeah.
So VCs don't understand it, don't know about it, don't care. Then I hear two quotes from VCs back then. The first is, "Oh my God, these prices are ridiculous. You seed guys are giving these people money. If I have to pay," I remember I had to pay 8 pre. I can't get 8 pre. I'm happy if I can get 8. I mean, if I get 10 post, I'm perfectly happy. And the other one was, if I see one of my companies buy another company where we write a check to Josh Kaufman on the cap table, I'm going to puke. So what was happening was the VCs all of a sudden noticed that the companies they got excited about already had an investor before them, which was not normally the case. That's why seed is now A. A was first institutional round. Now seed is first institutional round. So they thought, oh my God, these people are getting ahead of me. They're front running these deals. They're getting in front of these top entrepreneurs and giving them money and helping them become better and giving them the capital to become great firms. They don't say any of those words, but that's the truth, right? Or letting them die. By the way, I was always interested, so let me just ask you a question. You're upset about how much you paid for the company that you did in my portfolio. Are you going to pay me for the ones that didn't make it? because I made 0 on those and you paid nothing for them. So, how about dollar cost averaging and giving me a refund on those? Because you're being a real, anyway. So then they decided, we better get into seed. We better do it. So they started throwing darts, little tiny checks. That doesn't work at all. The only fund that didn't was Benchmark. They said, we thought about it a lot, and what we've decided is we'd just rather be friendly with the people that do it for a living. And so then there was an era where everybody figured out that spray and pray didn't work and little checks didn't work. And so instead, they decided they would romance the seed guys and gals. There were a couple gals. And so what did that look like? In a world where I make you $100 million, what do I get? I get thank you. Sometimes I get dinner. So the best funds would do dinners. Reid Hoffman would have us out to dinner, which is fine. I like these guys. I'm going to send them the deal flow anyway. But it was very funny to look at sort of the superficial simplicity of, well, we better make sure they're really, really, really paying attention to us. So how we do that? Well, we obviously wouldn't give them any economics. Oh, but we can buy them a really nice Greek restaurant meal at Evia. Okay, thanks. And now it's sort of a mixed bag of all that stuff.
Yeah.
And
so I want to open it up. Does anyone in the audience have any questions?
I told her in advance that
Yeah.
I am such a flawless presenter. There would be no questions because I would have explained everything you ever needed to know. Yes, sir.
You give that information to say anybody got questions. People like me are just still absorbing.
This much information from me and from us. Okay. There was
Yeah.
somebody else in the
Yeah.
back, maybe.
You're a good
So-
speaker.
Yeah, any speaker. I'm going to ask, which is, have you already given returns, or is just that because this is
no.
a tough market.
This is,
if you
yeah,
invested post
I will-
2021, exits have been very slow.
so I tell all my LPs the same thing. The fact that I have a top 1% track record, I tell them a few things. Top 1% track record doesn't mean shit if I don't keep going. Okay. Future is unknown. Now, there's a reason why I think that's less than true because of the way people measure success in mutual funds, which is what the rule of you can't believe whatever that is about prior returns and future results. And we can talk about that if you want. The second thing I say is, look, this is risk capital. When I put my money in, the only way I can have a shot at making 100+X in a deal is knowing that I can also lose all my money in the deal. That's it. Those two things have to be true. And lastly, I used to tell entrepreneurs this is a 7 to 10 year journey. It's a 10 to 15 year journey. If I'm giving you liquidity now in year 5, I fucked up. I have investments in about half a dozen funds. One of them sent me a distribution, and it immediately made me think less of him. He's a pre-seed fund in fintech in New York. He's sending me a distribution in year 3? Okay. First of all, that means he invested in somebody that didn't make it and had some crappy little talent acquisition. Fine. Don't tell me. Recycle the money. I didn't give you that money so you could give it back in some dribs and drabs of dividends. If I wanted dividends, I'd buy bonds. What is clear to me about that particular young, inexperienced investor, they listened to their LP's whine and they said, oh, we got to give them some money. So instead of reusing my money to make a new investment that would have a shot at success, decided to give it back. Terrible decision. Exactly the opposite of what venture is about. You are not looking for near-term cash flow from early stage venture, or you are fundamentally misunderstanding the nature of the game. Now, you should have other investments that allow you to have cash flow, because if you put all your money into illiquid 10+ year things, blind pools as they're called, and then you needed to pay the rent, and it turns out you put all your money in there and we have a dry year, whoo, ouch. Late stage funds are useful, PE funds, buyout shops, bonds, the S&P. There's a lot of different types of asset classes.
So you've raised your second fund, is that right? Or part
So
of
I
your
raised
second
half
fund?
of my second fund.
And
then
how
I
did
just
you do
decided-
that? I mean, you don't have return. So what made you attractive to those LPs? Is it existing LPs who believe in you? Do they look at the portfolio and say,
It's both existing and new. Well, part of it is, remember when I said Angelus says we're in the top 2%? That's for this fund, Fund 1. What they figured out, and this is interesting because here's the thing that always blows me away. Look, LPs are good people, often smart, not always. But their lack of willingness to look at the data is somewhat stunning. As an example, over the last 40 years, generalist funds have outperformed specialist funds, bar none. One exception was crypto in the early days. That's it, one exception. And yet, they're like, well, we really want our GPs to be specialized. Because you really want them to make less money? That's your goal? It's like, we really want to send our children to lesser education institutions. We've looked at the data. We actually, I'm sorry, we didn't look at the data. That's the point. We know there's a ranking of colleges in the world, but what we decided is we wanted to go to that one because it has 17 colors of buildings. And we think that's great because that's diversity. Dumb. But there's a lot of data out there to look at. And here's where this ties in both to my performance and to the way AngelList figured it out. They wanted to understand, how do you predict success in early stage seed funds when there are no liquidity events in the early days? And if they are, it means you didn't make a big investment. There's like 3 big investments that were early liquidity. And what they figured out was they back tested. They took all the data on all the funds. Number one predictor of future success of a fund is a term they call markups over baseline. Did somebody else pay more money for the thing you invested in? And this is somewhat obvious in hindsight. If your companies suck, no one will fund them. And if they're great, somebody will. And that sounds simple, but it's exceptionally hard. You know, I said 10,000 pitches, I funded 6. I'm 5 years in. I think I had 2 companies go out of business in the last 6 months. I mean, that's the nature of this game. As John Doerr used to say, and I love this quote, your lemons ripen first. But I've also got a company that's worth, I don't know, close to $2 billion. Is on an IPO path right now with the Goldman pre-IPO roadshow. So look, what I always say to my, it's funny, I have a very curmudgeonly famous LP, and I'll send him data whenever things go, oh, we had a nice markup. Oh, here's who, you know, so-and-so invested in this, or we just got this data from Carta. And he said, I can't eat markups. And I'm like, I understand that. And you should also understand that this food is going to be 10 years out, just like I told you it was. So don't try, like, you don't plant tomatoes today and go out in the garden the next day and start eating the leaves. Okay, I plant tomato. By the way, tomato leaves are poisonous. You know that, right? So you wait for the fruit. And what I said to him, when I said to everybody, is it's just a road mark. We're making a journey from, you know, Bay Area to New York City on foot, and we passed another mark on the highway. And I told you, guess what? We're at mile marker 326. Only 9,000 to go. I don't have a clue how far it is from here to there, but those markers are what helps people understand where you are. Mike Maples, by the way, when he started, before he started Floodgate, it was called just Maples Investment. And he raised his first fund purely, not even on what his markups were, but on who had done them. Because people looked at it and be like, wow, we can get into, think about it. You'll never, if you're not a Sequoia LP, you're not getting Sequoia deal flow. Well, you're not getting Sequoia deal flow anyway, even if you are an LP, but you're not getting their transactions. But if you can fund somebody that gets companies funded by Sequoia or Benchmark or Excel or NEA or whoever, then all of a sudden you have that exposure.
Ben, you're certainly distinctive as a, you know, kind of a solo GP VC fund, kind of Eli Guild, right? You guys are at the very top tier. Congratulations. I talk to so many of my single family office principal friends, right? And the more entrepreneurial ones, they get venture more than the real estate guys and the private, you know, private equity guys and the public market guys. But the fact is that I find that most of them are actually not very happy or uncertain investing as an LP into VC funds, right? The returns are low. Takes a long time, 7, 10, 15 years, no relation to the founders, and the GPs play games, etc. It's a common thing, right? That's one reason I wrote the article. And from your standpoint, how would you define success on a VC? Like as an investor myself, as family office, they don't want to hear all the shit about all the mechanics, right? This is one: returns, impact, have some fun. Okay, that's part of the portfolio.
At the end of the day, you are seeking alpha. You are willing to lock your money up for a pretty long time because of the shot at having a really material return. So my first fund ever, my first fund with my personal money or fund equivalent, was a 13.6x realized fund. My penultimate fund from about, I don't know, maybe 6 years ago is currently sitting at 13.82. I mentioned that because I was very worried that I'd never get back to that high water mark. One of that same curmudgeonly LP, he's great. He's like, Benjamin, my grandfather told me, you must be penny foolish, but pound wise. So I like that. I'm going to do that. He's like, no, you will not. So what do you mean? He's like, you told me you used 3 different hotel tonights in New York so you could save money. But I'm getting better. Anyway, he's awesome. I would love his wisdom. I'm not officially allowed to mention his last name. It's a famous last name. But one of the family members makes wine for the last couple hundred years. So, he said, what do you want out of this? And I said, I want a 10X fund. I can't guarantee a 10X fund, obviously, but so I have, as an example, bonuses in my fund structure. I get paid a bonus at, to be honest, I've forgotten. I haven't looked at my own documents in so long. I think it's either at 3X and 4X. I get bumps. And I will say out loud, it is beyond my comprehension that I could do worse than that. But life surprises you all the time. So who knows?
Do you take fees as well?
Yeah, but you give them back. You give your fees back as soon as you're in carry. This is the thing. This is why it's so frustrating to me when I see these funds, if you have no soul, no honor, and no intention of ever returning, go ahead and suck the fees forever, because who cares? But if you return, if you get into carry, I've done well as an entrepreneur. I've done well as an investor. I love what I do, but I intend to be really well paid for it. And I will be really well paid for it when I get carry. And when I get carry, I give you back all your fees. Like just the other day, my wife was saying something about how I traveled or something, and I still am. I fly business class now. I admit that, and I get better hotels. But I said, look, at the end of the day, it's still my money. Well, the LPs put it in. Yeah, but she didn't actually ask that way. But I'm pretending she did. I still have to give it back. Okay. So if I spend $1 million of your money over the next 10 years, I don't know, flying private, when I give you back your returns before I get carry, that $1 million is going right out of my pocket. I don't like that. Capital gains are great. Ordinary income stinks. Got 5 minutes left. So
okay, question over here.
Possibly the reason the fund is giving a distribution is it's a newer fund, and to attract investors, they're trying to differentiate.
But it's so stupid. The only people you're going to attract are idiots.
Yeah.
Who want? It's a pre-seed fund. Pre-seed. And you're giving me a distribution 3 years in? You're basically standing up and saying, hey, I invest in a loser. You see this loser over here? He sold.
But I think what happens is some of the limited partners, maybe they want that. So they're going after.
Yes, they do. You can't listen to them. Yeah. That's like if I have so many horrific analogies I can't use in public. But like, nah, I mean like, okay, so this is the most horrific one of all. If I live in California, I live in Silicon Valley. Supposedly people around here are polyamorous. I've only met one ever, 22 years. So maybe I should be. I think that's what I want. So I should go to my wife and say, honey, a lot of people around here are polyamorous. I would like to be polyamorous. To be clear, what that means is I will be with other people and you cannot be. Just so we're understanding it. That's what I want. Should she let me have that? No, absolutely not. Look, I am hired, in essence, I am paid to do what I do and have been doing for 18 years.
And so the quick question I have prior to that was, in terms of a seed round company that comes to you, what kind of revenues do you want to see in the rearview mirror if they have revenues? And then what growth? So 25 and then 26, what type of growth would you expect to see in the age of AI today?
Well, AI has definitely changed the inflection point of where growth happens and how big it can be. But I tend to look at seed with $500,000 to $1 million of ARR, and I like to see strong momentum in the near term. Well, I mean, here's an example of what I'd love to see repeated over and over again. I funded a company as a seed investor, as their lead, that was doing 2.2 million of annualized. It wasn't truly ARR, it was annualized when I invested. They ended the year at 6. Solid. It's been 3.5 years. They just crossed 500. That's the kind of momentum. The answer is sort of like the Supreme Court on porn. What they said was, we can't define it, but we'll know it when we see it. Porn versus art. The problem with the question, it's a smart question. It's that it changes constantly. AI has made it stronger, but I am not competing for the $100 million to $1 billion seed rounds in AI. So, I will be willing to go in pre-revenue, but I like revenue growth. Per No, pass.
Yeah, pass.
Already
You
done.
said that would, yeah,
No,
that
it's
would be
like
gone.
I was talking to a guy at a really big fund that should never do seed, but is anyway, and they do Series A's. And I was like, so what are you guys looking for in a Series A right now? And this was a couple of years ago. And they said, well, we like to see about $1 million in ARR at least. I'm like, wait, what? I'm sorry. Did we just travel back in time 10 years? No one's done a Series A with $1 million in ARR in my memory. Well, I mean, we need to see at least a 3x growth year over year. Oh, you're looking for a company that went from 0 to 333,000 to $1 million. He said, but we'd really like to see at least 3. I'm like, okay, there's your answer. Go from 1 to 3, and maybe you can raise. A friend of mine, and I know you have a question, so I want to make sure we get to it. But a friend of mine, Don Butler, wrote a piece on this, and he said, quote, what would get you a Series A in 2021 will not even get you a meeting today. The bar is only going in one direction. Art, you had a question.
We've got 2 minutes left. 2 minutes left. One more question.
No, I raised his hand several times, so I feel bad.
So I'm with BA. Thanks for being here. Great job. Thank you so much. So I have a curiosity. So if you took anything that could be qualified as a legitimate venture capitalist, and you are the exception as an individual, you're probably the golden dragon of individuals. But if you took anybody who's really a VC, not just an angel who put in $50, like you said, what would you say is the ROI across all of them for whatever period you want?
So it varies tremendously what the returns are, and there are great people. I think Crunchbase does this, PitchBook does, Cambridge probably is the best of what returns are. So I'll give you first a quote, and then I'll answer the question in a different way. I was invited to hear everybody, I don't have that much money, but that doesn't mean anything to a banker who wants it. So Goldman has me come to their stuff, and they had their private wealth person that was leading it. And he said, and I asked to follow up with him in person because I was so fascinated by this. He said, we think you should put our clients should put 45% of their capital into privates. And I was like, wow, that's a big number. And then they showed a chart, which was basically that those privates would, outdo the S&P by, I want to say, 5 points or something, enough to matter. So I went to talk to him, and he's like, well, first thing you should understand is our average client has $87 million. And I said, okay, well, it's a little more affordable to put that percentage in when there's that. And he said, and it is a blend because it's venture, private equity, buyout, et cetera. But here's the thing. There's lots of flavors of venture. NEA, tier 1 fund should give you high teens, right? Top quartile. But if you're investing for real alpha, smaller funds, bigger jumps, but you should outperform the market. I mean, nobody has the one thing I'll close with that's different about venture that's interesting versus a lot of, there's no hurdle rate. S&P's 10 and I give you 8. That's too bad. Now, not my interest. Again, what I would argue is while it's certainly very important, there's 2 answers to look at when you're making a decision. One, the history of the partners involved, because if the partners all change, it's different. And, are they motivated for that? What's their motivation? When they can suck down 3% fees and literally never pay you anything, well, I don't know if they even care at all. But when they really have both a strong history and a strong set of motivations, I mean, all you can ask is for somebody to give everything they have to something. And if they fail, well, did you pick right or did you pick wrong? You can't win forever. But.
Okay, and on that note, we're going to thank you, Ben Narasin from Tenacity Venture Capital. Thank you.
Interesting. Great talk, Ben. We appreciate your authenticity. So.